Ever thought your trading struggles were all about risk management or psychology? More often than not, that's not the issue. What's the real game changer? Chances are you're missing a crucial element, having a solid statistical edge. Hello, I'm Oskar, all the way from Estonia. In today's video, I'll be talking about statistical edge, the importance of it, the meaning of it, and how to identify it. And we'll briefly talk about how to develop a strategy that involves statistical edge. For more videos and content like this, follow me and 2 Trading on X and Instagram, and make sure to subscribe to this channel and leave a like on this video. With that said, let's get started. In the pursuit of trading success, it's common for traders to focus excessively on risk management and psychology. While these elements are undeniably critical, fixating solely on them may overshadow a fundamental truth: the lack of a defined trading edge. No edge equals no long term profits. You could have the best mindset and risk management, but without the defined statistical trading edge, you still won't be profitable in the long run. So, what exactly is edge as we talk about it? Statistical edge means that over a large enough sample size of trades, you will come out profitable ahead of the market. In other words, statistical edge means that the strategy has positive expected value, EV greater than zero. And the formula is expected value equals your win rate times amount gained minus your loss rate times amount lost. So, as you can see from the formula, you also need to consider your win rate, the size of your wins, and the size of your losses. So, let's walk through a few examples. First example, let's say you have a win rate of 40% and risk per trade is 1% and you have 100 trades. Every time the strategy plays out, you win 3R. Every time the strategy loses, you lose 1R. That's 1 to 3 risk to reward ratio. And your EV equals 60R. Now let's take the second example. The win rate is the same, 40%. Risk per trade is the same, 1%. And the amount of trades is the same, 100. But every time the strategy loses, you lose 1R, and every time it wins, you win 1.5R. That's 1 to 1.5 risk to reward ratio, and the EV equals 0R. So, a higher average gain in the strategy allows for a lower required win rate to achieve profitable results. Ever heard the saying, the house always wins? Well, in trading, you should aim to be the house. Just as casinos craft their games, your trading needs a deep approach. Essentially, the key to being the house in trading is to consistently trade a systematic and meticulous system. The house always wins is a fundamental principle. To thrive in the long run, one must adopt the role of the house. In essence, this means defining and understanding your strategy. Casinos understand their games and the associated probabilities, allowing them to stay in business. Even though losses happen, they remain unfazed because they know that in the long run, profits will come. Think of your strategy as a game or a table in a casino. Your primary tasks are to outline your strategy, check for profitability, and grasp its fundamentals and performance. Basically, when you're beginning to develop a strategy that fits your style, you essentially need a foundational concept that usually needs further refinement. At Tubi Trading, we have compiled some methods to get one based on our own experiences. It's worth noting that these methods frequently intersect and support one another. The first method is observation, which means utilizing keen insight and analysis of market dynamics, historical data, and trends to identify opportunities for creating a trading system. The second method is a logical idea, which means formulating an idea that can be systematically tested and later on built into a viable strategic system. And the third method is imitation, which means leveraging external sources for trading edges with the assumption that these sources can possess a genuine trading system that can be profitably traded. But what to keep in mind when it comes to imitation is that there are many strategies available on the internet marketed as profitable and ready for trading. It's important to understand that finding a genuine strategy with an edge is extremely rare. However, social media and interactions with other traders can be a great source of foundational concepts. Even if a trader or course claims to have a profitable strategy, it's best to independently verify its profitability through rigorous backtesting. Unfortunately, this is a common issue in the trading industry today. Social media is saturated with such claims. Many individuals aim to sell their courses or Discord memberships based on hindsight setups, but a significant portion of them lack systematicity. Only systematic strategies can be backtested and consistently traded in real time. Keep in mind that all these methods will likely provide only a slight idea of what to trade or when to trade. Typically, a viable strategy doesn't emerge from just the initial observation, primal idea, or external source alone. Edge is exceedingly rare, and this rarity is what makes trading hard and not everyone profitable. Constructing a system from an idea or a source is a lengthy process that demands many hours of research. It's almost always necessary to delve deeper into the idea and validate whether it truly holds the potential to become a systematic strategy that can be effectively traded. How does someone take a foundational concept and turn it into a profitable, successful trading strategy? In simple terms, how do you create a strategy that actually makes money? Analytical backtesting enables you to test your initial idea or model and incorporate various logical variables to assess if they increase your profitability. This approach is a great way for you to build a system from your foundational concept and enhance its long term profitability. It's an amazing tool to refine your system and optimize it. When deciding on variables for your trading strategy, it's essential to focus on key components. While there are numerous options to consider, the general rule is to include one or multiple defined buy and sell guards, signals, and triggers. Additionally, it's essential to gather information about profit taking and optimal stop loss management and sizes. You can incorporate various variables to determine the optimal sizes for these aspects as well. Guards provide contextual information for your trades. Examples: higher and lower time frame bias, time of day, and volume profiles. Signals indicate when to begin actively seeking trade opportunities. Examples: high and low rates, divergences. And triggers prompt you to enter into trades. Examples: different entry models, Fibonacci, imbalances, single prints, and supply and demand zones. There are some key components to take into consideration from the last slide. Firstly, one variable can be used for different purposes. For example, volume profile is a great guard as well it is an effective buy or sell trigger. Secondly, every variable you use has to be properly defined, meaning that when analytical backtesting, you can't just subjectively decide if the variable was in play or was it not. Before analytical backtesting, you need to define every variable so you can leave out human errors when backtesting. As we wrap up this video, looking ahead, let's talk about what's next. In our upcoming series, we are excited to introduce three main topics: guards, signals, and triggers. We'll explore different methods, tools, and indicators that we have found helpful in trading. We'll explain how to use them in context, how to use them in your data, and discuss their pros and cons. Stay tuned for more insights into trading strategies. And last but not least, what we learned today. Trading success needs more than just managing risk and psychology. Having a clear edge matters. Statistical edge means your strategy makes money over a large sample size of trades, showing it's a winner. Always remember the house always wins principle. Understand and define your strategy for a long term success. Analytical backtesting is a powerful tool, helping turn trading ideas into solid strategies through testing and analysis. You can't skip the backtesting. Even if someone hands you a strategy, you must validate it through your own testing and analysis. And that's it for today. Stay tuned for more content like this and make sure to follow me and to be trading on X, and make sure to subscribe to this channel and leave a like on this video. Till the next time.